What's going on, guys? Sam Norris here, the property investors broker. Today I want to talk about social housing as a property investing strategy. Now, some of you might know that I have been recently talking at a few events to do with social housing and, chucking in my 2p's worth, if you like, for how you can get mortgages for this type of strategy, basically. So I just kind of wanted to go through on a quick video, why I think this is such a great strategy, particularly for 2020. Now, as many of you will know, Section 42 kicks in and property investors have had to be a little bit more creative in terms of how they actually get the most out of their properties, because now the interest that they pay on their mortgage is no longer seen as a tax deductible expense by the government if you own the property in your own home. Now, lots of people have been pushing their properties into limited companies, which has been helping on that front. But for those that aren't, they've had to try and find different ways in which to make the most out of their properties, like I said. And one which way is to start renting your property through a housing association for social housing purposes. Now, this can have some fantastic sort of gains in terms of making more money from your property. Now, the main thing for me on this is that you are handing over your property to a housing association to rent to tenants in need or whatever the tenant profile is. And they will take care of the management and maintenance of that property throughout the term or the lease term when they have the property. So that actually takes away two potential expenses from your sort of monthly annual bills, if you like, which can be a massive improvement and impact on your cash flow. So that's sort of one thing to be aware of. Now, the other thing, of course, is that when you rent to these social housing companies, usually you're looking at a lease of between 2 and 5 years, which means that you kind of have a bit of a hands-off situation, and your income from those properties remains a little bit more passive. And for me, I think this strategy is nothing new. People have actually been doing this for a long time. I think it's just become a bit more prevalent recently with the impact of Section 42 and people trying to be a bit more creative. There's a bit of a stigma, I would say, surrounding this. People don't like the idea of renting their property to maybe people that have been recently homeless or drug and alcohol dependent, that kind of thing. And it does mean that people are less likely to see this as a kind of prestigious strategy. It certainly isn't. It does obviously, as I said, carry a bit of a stigma. But I first got introduced to this strategy because one of my clients who owned a property in Wigan actually rented his property to Brent Council, the Borough of Brent Council in North London, was getting rental rates that you would get in North London on a property in Wigan. Now, from his perspective, that meant a huge increase in his cash flow, and it was a ridiculously high yielding property as a result of that. But that introduced me to the strategy in quite a unique way. But since then, obviously, I've been working with lots of clients that that will own a property, say in Birmingham, they will be renting it out to a housing association in Birmingham, and so it makes that's a bit more normal, and that's kind of how you would do it. But you can be a bit more creative if you want to, and that's that was how I kind of got introduced to it and how I saw what the strategy could actually end up doing in terms of increased cash flow, etc. So, but one of the things obviously I speak about when I'm talking about social housing at some of these seminars and meetings, etc., is actually how you finance them. People get very excited by the prospect of this type of strategy, and sometimes I'm the one that has to be sort of the bearer of bad news, that lending options are not as great as maybe they should be and could be. And I'm really hoping over the course of the next 24 months or so, 2 years, 3 years, that I think lenders are going to wise up a little bit more, because I think the strategy is going to be used a lot more. I'm certainly doing my bit to speak to lenders and talk to them more about this and talk to them about how clients are getting into it and being and using it a lot more. So I am hoping that it's the number of lenders grows. But the one thing to really hammer home on this is that social housing is not a product when it comes to mortgages. It is a criteria point. So if you were renting your property as a serviced accommodation rental, there would be specific products that a lender would allow you to have to cover that. Maybe it might be a short let or a holiday let product. Social housing isn't like that. It's a criteria point. So the type of property that you have, whether it's a single let, i.e. it's rented to a family, or it's an HMO, i.e. it's rented to lots of individuals that have individual rooms, they will be the products that we're actually going for. But then it's, do those lenders that have those products have it within their criteria to allow for properties to be rented out to a housing association, who then in turn will be renting them out to individuals. So these are the things that we kind of need to be aware of is in that criteria. So number one is something I've already mentioned, which is the length of the lease. 2 to 5 years is normal, and that's what we're looking at with these residential, these aren't commercial lenders, these are residential lenders criteria. 2 to 5 years is what they are comfortable with. They'll also want to see that there's a 12-month break clause in there, so that if they do need to repossess the property for any reason, they know that they can get hold of it and control it completely themselves in a relatively short space of time. They're also going to want to see in the lease a tenant profile, because there'll be certain types of tenants that maybe certain lenders won't like more than others. Asylum seekers has been one that's come up recently that certain lenders aren't happy with. Those that are drug and alcohol dependent, and those that are maybe in the property for a very, very short period of time. I've done something recently where the client, the average turnaround of the client is about 30 days. So some lenders weren't comfortable with that as well. So it's good to know sort of those basic things that are going to be on the lease before we're submitting applications to lenders. We want to get that in front, those kind of leases in front of underwriters to make sure they're happy with it. And that's how they will determine whether they're happy to lend. But they're not going to load the interest rate or change the product. It's basically going to be a buy-to-let or an HMO product within their sort of with their product range. It's just very much to do with the criteria of the lender, not the products themselves. So that's kind of really the main thing to focus on with this is the lease itself. So if you are looking to get into this type of strategy, it's very, very important that you get some kind of draft lease in place as early as possible with a housing association, so myself or your broker or whoever can actually go to a lender in advance, or go to lenders in advance and say, are you comfortable with this lease? And I have had situations where they've said, yes, we are, but this one particular point we're not particularly comfortable with. And we've actually gone back and forth a little bit and managed to get that changed and found a way forward. So that's definitely the most important thing when it comes to lending. Now, if this is a sort of strategy that you're trying to get into, it does tend to favour those that are a bit more experienced. I have managed to get a mortgage recently for somebody that not only doesn't own their own home, but was actually buying their first property to be rented out as social housing. But we are looking at quite high interest rates there, moving towards commercial-esque interest rates. It still works because the cash flow is usually better, but it is just something to be aware of. If you've got some experience, 1 to 2 years worth of letting experience, you are likely to have many, many more options when it comes to lending. So that's something else to bear in mind. Now, I did just promise this was going to be a very, very quick video, so I am going to wrap things up. But just to summarise quickly, social housing is definitely a hot strategy, I think, for 2020 and beyond. The things that make it a good strategy for me is that it really takes the maintenance and management of your properties out of your list of things you need to do or pay out for on a monthly basis, which can increase your cash flow even when Section 42 is doing its damnedest to try and dent that. It does mean that your income is a bit more passive. Someone else is genuinely looking after a property for a period of time. The lease is extremely important when it comes to lending. 2 to 5 years, making sure there's a 12-month break clause, and making sure that there is a tenant profile in there. So I really hope that this has been helpful, and anyone that is looking into this as a strategy, take these things on board and maybe do a little bit more investigation in terms of local housing associations to you or to your investment area, and see what their requirements are. If anyone does want to follow up on this and give me a shout and talk about it, please feel free to write a comment in the comments below, and I'm happy to have a chat with you about it. Also, feel free to get in touch with me in any case. Instagram at the Sam Norris, Twitter at the Sam Norris, TikTok at the Sam Norris. You can search for me on Facebook, Sam Norris Property. You can search for me on LinkedIn, Sam Norris, and you can obviously find me on YouTube as well. If you haven't already, you may well be watching this video on YouTube. So they're the ways in which you can contact me. Whatever you're doing today, have an awesome one, and I'll catch you on the next video. Cheers, guys. Bye.